Now we're going to pivot into autos and other pricing pressures, looking at consumer sales, what's happening with spending, what is going to happen with tax credits, because this is all going to lead down to where does the world sit, or at least the U.S. in terms of their spending patterns, as we are the biggest consumer in the world. So one of the things, as we ended last segment, we wanted to talk about U.S. automobile inventory levels, which, as you can see here, are at the lowest levels going back to 1969 when we look at what is available for sale. And this is where we continue to see pressure on pricing. Some of that has started to get to alleviate, just because we are seeing sales slow down, just because, again, we're just not seeing the same. People aren't willing to pay those prices, and the inventory levels are just not, even as demand is slowing, so is supply. We need to see demand slow and supply pick back up. And just given chip shortages, steel prices, labor costs, we're just not seeing that happen. And that's going to keep some of these pressure points. So then when we take the auto inventory to sales ratio, you just get an idea of just how low this really is going back to January 93. So not only just on an inventory level, but on an inventory to sales ratio, we're still seeing significant pressure that it's getting better, but it's not getting better where it's going to snap back up. It's just going to stop going down as we just get less and less demand, which means that the sales side is going to get lower. So as you get a lower sales, the denominator will get reduced. So you're dividing inventory by a smaller number, which just means that you'll start to see this pivot back up, even though inventories are still going to remain low. So then when we take that and look at, well, why is that the case? Well, the Conference Board Consumer Confidence for buying a new automobile is at the lowest since 2011. Because why? Nobody wants to buy them at these prices, so they're willing to wait. And then when we look at vacations, so we had our surge, because again, we're looking at discretionary things. We're looking at things that maybe people will wait for a car. Do you need a car right now, or can you wait 6 months? Same with airplanes. So when we look at vacations, pressure on just that, how people are spending their cash, you can see that we had that bounce off the bottom, but then we had that fall down fairly quickly, and we're going to see again some more of that seasonal pressure. Then when we look at U.S. auto sales in general, so again, the sales have continued to dip. The survey was for 14.45, came in at 13.06. So you're just seeing, this is what we're talking about with inventory to sales. Sales are dipping as those inventories continue to remain at significant lows. But we keep talking about the Conference Board. Well, let's look at what this looks like in comparison. So we were sharply lower, 113.8 versus an estimate of 123. And then in July, it was 125.1. But present situation fell, continued to fall, expectations fell. So this is where the consumer, on a lot of levels, depending on who you're asking, how you're asking, it's just you're seeing a little bit more pressure on how are people spending. But they're still spending. Like this, it's just they don't feel as comfortable as they were. But when we go back through history, especially when we look at consumer confidence, we're still at highs. So again, these are some things where the pace is just coming off, but we're still at very strong levels. And that's some of the things some of those caveats that we have to consider when we're looking at some of these data sets. So then when you look at just on the expectation side, this is when things are getting slower. And this is what gives us concern. So people are okay right now. It's just, what do they expect going forward? And that's when we start looking at these slowdowns, these fiscal drags in terms of, a lot of people pulled forward these purchases, and now they're like, look, I don't feel that great about going forward. How many people are going to keep buying cars and houses and appliances? And that's where we're starting to see some of these more aggressive shifts in general. And then when we consider the business better 6 months, we're coming back to where we were pre-COVID as things starting to normalize, as consumer confidence, expectations for better business conditions in the next 6 months has continued to worsen. And when you look at, well, what is the consumer looking like? Well, they're a little bit concerned as well. And that's where we're continuing to see some of these pressure issues arise. And that's where you're starting to get some of this caution. But again, right now, things are okay. And then when we look at U.S. consumer confidence measures, this is just looking at them together where you're seeing both of them are moving in the same direction. It's just obviously from much different levels given on how it's calculated. But how are people spending? And I think this is the one, when I actually had this conversation with my wife of the buy now, pay later. It's typically used by lower income, younger, and a more racially diverse crowd versus credit card owners. Because do you have the credit to get a credit card? Do you have, or what is the rate? Maybe there's a rate of the buy now, pay later. Because when you're buying now and paying later, you're typically using the company's balance sheet, and they're going to pass on that risk to you, and they're going to evaluate it themselves. So, let's just say Citibank will tell Ray Moore and Flanagan, look, you have great assets, you have a great balance sheet. I will give you money at, let's call it 5%. So then they can turn around and say, okay, well, I can open up a credit card, I can do all these things, but if I don't know if that person is going to have a credit card, well, let's do a buy now, pay later setup where I will front you some of this money and then you'll owe me money on the back end. And then if you don't pay, I come and reclaim the asset, because there is a backdrop, which is rent-to-center when you look at some of these components. So when you look at the general risk overall on an income level, 64% use the BNPL or buy now, pay later. On a generational level, when you look at Gen Z or the millennials, you're seeing more millennials using either both credit card and buy now, pay later, or just the buy now. And then when we look at race and ethnicity, when you're looking at the Hispanic and Black community, they are using more of that BNPL versus credit, or they use a mixture of both, which is also becoming something that you're seeing more millennials do. But there's also timing. When you think about the amount of availability of the buy now, pay later, I mean, how many commercials have you seen of, well, zero money down, take it home and pay, interest-free loans for 12 months. So there's also more options now. Not to say that the 5 and dime, if you will, going back in the day, we didn't have the similar option, but again, it's coming back into favor once again with such cheap credit. And then the use of BNPL in June report higher income volatility, which isn't overly surprising. But when you look at the lowest quintile getting a little bit better, then there should be a little bit less volatility, because when we look at incomes, people that are in that top 4 quintiles, they're typically salaried, or at least the top 3 salaried, have some savings. So the volatility is in that bottom. So as those hourly wages climb higher, that will provide some security and some of that pricing. And then roughly half of the BNPL users without a credit card say finances often or always control their life, which for anybody that's been in a tough position, as not to be too personal, but as something that we're facing right now, it's true. You're always worried about what is the next project, when is the next deal coming through, because you're concerned because you're trying to build something. Are we going to have the money? And given, it's everybody's experiencing in different ways, whether you're bootstrapping a startup, whether you're living paycheck to paycheck, there's a lot of these uncertainties and stresses that come through, which is why you have, trouble sleeping, you have these concerns, and you do have that volatility, which is being reported. But how has it changed? So when we look at retail sales, so when you look at the retail sales side versus everything else, retail sales are still far above that pre-pandemic level when you consider where we sit. But it comes down to value versus volume, because prices have exploded when you consider it to 2020, even 2019. So there is going to be that increase, but you're starting to see it come back down because the value is now eating into even greater than the volume side, which again is creating some of this movement back down to, not to say that it's collapsing, because it's not. It's still elevated. You still have government transfers coming through. You're just coming down to a bit more of that normalcy that we've seen over this time period. And then that's when you start looking at U.S. personal consumption expenditures. So year over year was at 3.6%. And then when you look at chain type pricing, was at 4.2%. It's starting, and again, this is what we keep talking about. It's the pace of it is slowing, but it's still going up, and that's what we keep trying to highlight extensively. it's going to continue to go up. The pace is just going to slow, but that is going to be that growing pressure, which when you look at the Fed in terms of easy money, the easiest money we've ever had, when you look at, again, it's easy money back to the buy now, pay later, this is where you can start getting into trouble and you can start seeing some of these problems, not today, but in 12 months from now when, okay, well, that person didn't pay for it. So when you start reclaiming items, then what is that inventory going to look like? So could we all of a sudden have a huge flip in inventory where everything looks super low and then you start reclaiming these used assets and now all of a sudden you have a balloon in inventory that really isn't worth what it was when it was new? As anybody who's ever tried to resell furniture, you pay $1,000 and then you resell it for $100. Like, it's just, even if it's a year or two old, these are some of those pressure points that again come back to through the system. So when we look at U.S. personal income ticked back up. Again, that's that percentage side that we keep talking about. And in nominal dollars, they keep going up because we do see wages going up in general on the lowest level, which is providing some of those bumps. And then the upside surprise for July, personal income at 1.1% versus the estimate of 0.3%. Personal spending at 0.3% versus the estimate of 0.4%. So real personal spending, though, was negative 0.1%, which was right with estimates, which again is that inflationary pressure, that pricing side that we continue to talk about and that we talked about on Friday. So then when you look at this conversion, so again, the total is starting to ease out as goods continue to come down, but services are essentially going to converge. So goods will continue to slow, services will keep picking up, and we'll see this meet in the middle. But on a value level, goods cost more than services. So on the aggregate, you're going to see that come down in terms of the net dollar amount that's going to contract and move closer to that normal side as we do get more pressure on the goods side. And this is one of the things that we were talking about. So for the first time, average pay for supermarket and restaurant workers tops $15 an hour. $15.31 is the average in June. And we know in July and August, it has gone higher. So there's going to be that additional movement, as we've talked about. We're closer now to about $16.50, $17. Not so much on a national average, it's probably closer to 16.5 on the national side. But again, these are some of those pressure, the benefits at the lowest level, we're just not seeing that come through at the highest wage point. So then when we start looking at tax credits, the child tax credits, should this be permanent? And this is where the share who said they support up to $300 monthly child tax credit payment per child. So in terms of about 50% say that they either support or somewhat support that idea. Not surprising, a lot of it is by Democrats, where almost 75% think, or I should say over 75%, or actually exactly 75%. I can do math in my head. You're seeing that this is where you're starting to see the overall benefit in terms of where things are. It just where things are going to go, and that's going to be the driving side. So when we look at the current backdrop of a Democratic-controlled president, Senate, and House, how much of this has to go through now before 2022? Because can they hold the House and the Senate in 2022? Because if they lose one or the other, or both, obviously this isn't going to come through based on how Republicans view the issues in terms of, again, that fiscal side. And given one thing that you have to slap Republicans for is they talk about not spending money when they're not in power, but then the moment they get in power again, you could essentially not even flip it. It's just they become mirror images of Democrats, because everybody talks a good game about not spending until they're in power, and then they just spend blindly. So again, these are habits that we need to break. So to call Democrat versus Republican at this point, especially on spending, is just they're one and the same. Again, left hand versus right hand, as we always have talked about. So then when we look at the share who said they think the child tax credit payment should be made permanent, this is when you start looking at a little bit permanent side in terms of what is the number, and then this is using what is the number right now. So you can still see that Democrats still believe that's a huge thing, but again, the Republicans and even independents get way more concerned, which is why I think it's going to be a tough sell, especially because the independents or middle of the road don't agree or don't feel the same way. But then this just gives you an idea of what does that tax credit look like. The child tax credit in July, this is that pickup in that monthly government support and government transfer that is providing some of that support for spending, some of that support for the at-home parent, for the parents with kids at home. Then July personal savings rate rose to 9.6% versus 0.8% in prior months. So we just stopped going down, and it's going to be a matter of how quickly does this start to come back into the market, because then when we look at Americans are not desperate to find work, and how come? So there's the unemployment payments, which are, it still was the big reason in June. Care responsibilities, again, kids home, starting to go back to school, that will start to adjust again. But financial cushion, why? Why do I have to go back to work? I have money in savings. I've created a little nest egg. Why am I going to rush back? And that's, I think, some of the things that we're continuing to see as COVID fears start to go down, spouses employed starts to adjust. So we start to see some of these adjustments in general, which again is just causing some of those limitations when we consider the care responsibility. But the UI payments is a big one. And then when we talk about the spouse employed, but the financial cushion. So we did see some of these savings come up. We did see some of these adjustments. Now it's going to be a matter of what does that financial cushion look like and how does that get whittled down, looking at ADP. So payrolls from ADP, 374,000 in August versus 638,000 estimate, 326,000 in prior month. So your trend is moving in the right direction. The question is always how does that trend continue? And this is where we think August is staying strong, and then September is when we start to see some of these bigger headwinds. And this is the states that will see that drop off in terms of emergency unemployment benefits expiring September 6th. So then when we look at weaker July growth followed by benefit cuts, that's not surprising. So July state payroll data confirmed that employment growth was actually 10 basis points less in states that ended expanded unemployment insurance early, an important month to assess given just over half of states in U.S. ended benefits early. But now will we see that carry through into, again, the next cycle of just data sets as we look towards growth comparisons? So half of U.S. states ended enhanced benefits early, and the other half, including the District of Columbia, maintained them. So change in non-farm payrolls April to July, not much change. So again, it's going to be a matter of, are we going to see that as we go forward? But when we start looking at schools, so number of private nonprofit four-year U.S. colleges that shut their doors, we're seeing an increase. Why? Because people can't pay it. They can't afford it, or they don't want to. And this is something that we're going to continue to watch, because I think you're going to see more and more pressure on tuition and just underlying prices. So then when we look at construction spending, well, construction spending up in July, 0.3% versus the estimate of 0.2%. But where is it? Residential home improvement was up 0.2%. Private non-residential was down negative 0.2%. So again, you're still seeing construction staying strong, but it's just that mixture of where is it being spent, which is, again, is that on the residential side and not on the non-residential. And then when we look at, well, okay, so construction is there. Construction is still staying strong, so you still need to hire people. But when you look at the percentage saying it is a good time to find a quality job, continues to go up and is at the highest since COVID started and going back to 2019. So they still feel confident that they can find jobs. So it's just going to be a matter of actually going out and getting a job. So then when we look at new job postings on Indeed, we're past the peak, but still elevated. So again, there's still new jobs going out there. There's still this opportunity to be and take your time and try to interview and find the right assets or the right position for you. All the while, U.S. core inflation continues to trend higher. And this is what we're looking at when you look at a 24-month average, the 3-month annualized, the 12-month. All of this is pushing up in again, just driving us higher, as we talked about on Friday. So the price impact. So when we adjust it for inflation, you can see that U.S. personal spending declined in July, and we see this continuing. And that's as prices go up. I think we continue to see some of these pressure points as we go through the remainder of through the remainder of the year, especially with the government transfers coming down and costs to the consumer going up. And so the contributions to monthly core, again, vehicles is becoming less and less. Pandemic-affected services are still elevated but coming down. It's the other or everything else that we think is continuing to go up, specifically rent, as we talked about in the previous segment and the most recent segment. But when we look at aggregate compensation growth, as we talked about with the lowest quintile, aggregate compensation reflecting both number of employee and wage benefits paid grew at 0.9% month over month, a strong pace. For comparison, there were only 9 months from January 2008 to 2020 where compensation grew at a faster pace. But again, it's at the lowest level, which is good for some stability, but it doesn't really drive that discretionary spending where the highest level has that discretionary spending in general. So then when we look at, okay, well, let's look at sales in general and where the compensation was. So services continues to go up, goods continue to fall. So this is what we keep talking about with the contraction down, but services are not growing at the level goods are falling. So that's where we see this, again, this contraction down, still positive, but it's just the total is gonna start to roll over and settle somewhere a bit lower. And this is when we're looking at U.S. personal consumption expenditures still, again, as a value, continuing to track higher. But when we look at just that value side, that is, again, that volume versus value that we have been harping on. And then this is when we look at real consumer spending versus trends. Goods are down, services up, total compensation. When we look at that gap, continues to narrow and will continue to breach that gap in general. And then consumption growth cratering temporarily. When we look at just what is the actual real consumption, 3 month on previous 3 months, well, when you look at just the aggregate side, but look at the surge. So again, you had that dip, you had more money coming through because we did have new stimulus in April into May. So you had that pump, and now we're just not going to see, we're not getting that next leg of money. Again, there is that child tax credit, but it's not a $1,500 check or $1,200 check. So that you'll see that continue to whittle down over the coming few months. And then the core PC inflation continues to drive higher. We don't see that changing. We see this continuing to go up. Again, the pace is just going to level off a bit, but still be on an upward trajectory. And it's going to be driven based on this real consumer spending because the real personal income still elevated, but real personal income ex transfers is still slightly negative. So it's still the government that is driving a lot of this excess. And as that continues to go down, and especially when we look at unemployment benefits and these other benefits starting to expire, that'll keep things a bit more depressed, especially when we look at the personal income dynamics. When you look at transfers to households and unemployment benefits, the yellow is going to be gone officially, completely September 6th. And then those other transfers get smaller. It'll still be there, but it's just smaller with that tax credit. So we're going to need other compensation, other incomes to offset that. And based on the trajectory, you're going to see some pressure on those numbers on that data set. And this is when we start looking at durable goods, where the survey was 0.5, actual was 0.7. But you can see the trend is still kind of this sideways move. And based on what we're seeing, it's going to start to roll over a bit faster than previously, just given the shift from, again, goods into services. So now we've covered everything for the U.S. We want to take a turn and look at what's happening in Europe and what does that really mean going forward for for the end of Q4, really the end of 2021 into 2022.